Hope everybody's doing well this soggy Thursday, at least for South Florida. As you can see, our panelists are already in the virtual room, ready to go. We want to give everybody a chance to dial in. We have folks from all over our law firm's footprint: New York, New Jersey, Chicago, and South Florida participating today. So this should be a very robust conversation with our participants that have been very kind to spend some time with us. Okay, we're gonna get started, folks. As you see, we have all of our participants in the virtual room now. I wanna thank everybody for joining us to our webinar. The title of today's webinar is Own Commercial Real Estate and Need Capital Now? Who you gonna call? That was the catchy title we decided to come up with. It's basically what financing sources are out there in this COVID marketplace, right? We know institutional financing has tightened up and the opportunities to get financing from traditional institutional lenders is limited. We are going to talk today with panelists that are offering secondary and tertiary financing, as well as mortgage financing that you would have otherwise probably gone to an institutional lender for. But this is really, the people that are in this room right now are people that are putting money out there on the street right now, last week, this week, and next week. So without further ado, let me introduce myself. My name is Luis Flores. I am the managing partner of the Miami office of Saul, Ewing, Arnstein, and Lair. My core of my practice is real estate development. I find capital markets to be particularly sexy, so that's why I put this panel together. They kind of drive what types of transactions we see in the marketplace. Without them, we really can't really get transactions done, in my viewpoint. I'm very active in the firm's real estate practice group, and that's pretty much who's hosting this webinar today. So without further ado, I'm going to just introduce everyone, and I'm going to give them an opportunity to talk about themselves and where they're from. As you see, not sure where everybody sits on their particular Zoom, but we have Kathy Anderson. She's a founding partner of Progress Capital. We have Stephen Fischler. I call him Fish sometimes. You'll hear that during the call. He's the Chief Investment Officer of a group called RMWC. We have Chris Kane. He's the Executive Director of Business Development and Originations with Hannon Armstrong Sustainable Real Estate. They sometimes just go by Hannon Armstrong. We also have Elon Peretz. He's a Managing Director and General Counsel of Barnett Capital. He operates out of Chicago. And we have Manish Shah, he's a principal with Two Kings Real Estate. He works out of New Jersey, New York, I believe. So before we dive in, some few housekeeping announcements. If you're familiar with Zoom, you'll see that there's a Q&A option at the top of the page. If you just put your finger on that, you'll be able to submit questions during the program. We'll tackle those probably in the second half of the program in the last 30 to 15 minutes. The expectation is that the program will go for an hour. We may go over that hour depending on how many questions we have, but we will be trying to address as many questions as possible. And then if anything, we'll follow up at the end of the seminar, post webinar, pardon me. All right, so if we're doing a law firm webinar, I've got to give you guys all a legal disclaimer. All the information we're giving you today is not legal advice, does not create a lawyer-client relationship, and should not be acted on without seeking professional counsel, like the man standing in front of you, or like all the relationships you have at our law firm. So with that, let's begin. So welcome to the webinar. Why don't we go around the virtual room and have each one of you introduce yourselves, talk about the company that you lead or you work for, and pretty much where you're located right now. So why don't we start with you, Kathy, then we'll go to Fish and so forth. Kathy, go ahead, introduce yourself.
Hi, I'm Kathy Anderson. I started my company, Progress Capital, 30 years ago, and we're a commercial mortgage advisory firm. Mostly in the tri-state area, but we do work nationwide. So we handle all parts of the capital stack: senior, mezz, preferred equity, construction, acquisition, the major food groups, multifamily, industrial, office, self-storage, anything that is commercial in nature, and you need to have any part of the capital, we're here to help you out.
Beautiful. Stephen, why don't you tell us a little bit about RMWC and where you work and what you do? I think Stephen's on mute.
Can you not hear me?
No, there we go.
I was not on mute. I'm Stephen Fischler. I'm a co-owner and chief investment officer of RMWC. Started in 2008. We're a nationwide mortgage, mezz, and pref equity lender on all sorts of commercial real estate.
Beautiful. Chris Kane, you're my alternative financier on the panel today. Why don't you tell us a little about yourself and what Hannon Armstrong does?
Hey, good morning. My name is Chris Kane. I work for Hannon Armstrong Sustainable Real Estate. We brand in a couple markets somewhat differently, sometimes as Counterpoint Sustainable Real Estate. And specifically, we are a specialty lender in commercial property assessed clean energy. So CPACE, we work all around the country. Our capital partner is a publicly traded mortgage REIT called Hannon Armstrong. They've got about $6 billion worth of capital under management. Every year we originate about $1.5 billion to $2 billion worth of predominantly new investments in either the energy or the construction space for commercial real estate owners.
Beautiful. Thank you very much, Chris. Elon, why don't you tell us a little bit about Barnett Capital and what you're putting, what you do and where you're located?
Thanks very much, Luis. So Elon Peretz with Barnett Capital. Barnett Capital is a single-family office located out in the suburbs of Chicago, Illinois. If you're familiar with the area, we're up in Northbrook. Family that I've been working for 15 years, wealthy family. And I'm in charge of a pool of a couple $100 million of investable equity that we deploy up and down the real estate capital stack. So we're active in first mortgage lending, we're active in mezz lending, we do a little bit of pref and a lot of JV sponsor equity.
Beautiful. Thank you, Elon. Manish, tell us a little bit about Two Kings Real Estate and where you're situated.
Sure. Two Kings Real Estate is based out of New York and New Jersey. We do invest nationally, particularly in multifamily and hospitality. We are second-generation real estate folks that partner with institutional capital and other family offices, as well as using our own capital. We started in 2007. We had a distressed discretionary fund at that point. But we are very integrated in terms of vertically integrated owner-operators for part of our assets. And then we provide capital to other people in the segments that we find attractive.
So let's expand upon that a little bit, Manish. Let's talk about the loan and equity products what you're closing nowadays. What types of loan and equity products are you putting out there in the marketplace, and what do they look like?
So specifically, right now in this cycle, we're finding either acquisition of mezz positions where, for example, the current mezz might be causing trouble for the current borrower, and they want someone who can deal with accruals and not current pay, because especially when we're in hospitality, current pay is just not realistic or would require funding of the current pay. And the second element is preferred equity. So we're finding preferred equity or rescue financing, reforming a capital stack is where we're most compelling. And again, I would say, while we have done different sectors through our history, particularly multifamily, right now, hospitality, which is really the origins, and like I said, we're second generation, hospitality is where we're finding the most interest for what we offer.
So when you look at if I was looking at your assets right now that you're making loans on last week, this week, next week, what does that pie chart look like? Does it look like 50% hospitality assets, or what does it look like?
If you look at the last 3 months, it's 100% hospitality.
And you're coming in a mezz position and a second position. Is that right?
It's a second position. It's often preferred equity, because what's happening in general is there is CMBS or some other kind of lender in the senior position, and our capital is after them, but ahead of the existing equity.
Now, we talked about this last week. If I'm correct, Manish, you're still taking limited guarantees. Are you taking guarantees on the back to back up that PE?
No. So if we're coming in as pref equity, we are not asking for personal recourse, or if that's what you mean, we're not asking for personal recourse or guarantees for the operators. We'll have springing, the equivalent of the normal non-recourse carve-outs. So if they do bad acts or bad actions, certainly we could have things that spring up, but we are not, unless we're buying an existing mezz position where those guarantees already exist, which we haven't closed on one like that. We're not asking for personal guarantees.
Got it. Now, let me shift over to you, Elon. I know you've been very active kind of in the same space, but you also do a little bit of mortgage financing. Why don't you tell us about what kind of products you're putting out there and what they look like?
So in the last, I'd say 6 to 12 months, we've been focused in terms of where we play in the debt capital stack, for the most part on first mortgage debt. And historically, there's kind of a big break in terms of what assets we saw and the velocity with which they've been coming that I think is tied to COVID. Historically, our first mortgage debt was generally we play north of banks' cost of capital, so it needs to be assets that banks aren't financing. So historically, we saw a lot of land. That's
Yep.
something, as a family office, if I can get land at a low basis. So if I'm a lender, I'm probably at, 50%. Pre-COVID, I was probably on development land, 60, 65%. Saw a lot of deals with developers who were putting their capital stack together, and then ultimately just couldn't kind of coordinate the debt, the equity, the construction documents, and everything that they needed in time to close on a particular piece of land. Oftentimes a piece of land where they may have even created some value already through entitlements, right? And kind of a zoning contingency period. So we'd be there to bridge 12 months, 18 months, 24 months while they put together that capital stack. That volume has increased tremendously post-COVID because there are holes in those capital stacks for those larger projects. Maybe they had equity, but the equity went away, or they had two potential equity partners, one of them went away, that they thought they were going with. They couldn't find the construction debt right now, but they're confident that 6 to 9 months from now, they'll be able to find the construction debt. So we do real estate bridge loans, a lot of land, and then to speak to Manish's point, post-COVID, I've been seeing and dipping a toe in the water, hospitality assets come our way. For the most part, unlike Manish, it's not a pre-existing capital structure that we're helping to restructure or recapitalize. It's the folks who are smart enough to have their horns out and figure out what a good post-COVID price for a hotel asset is. I can say I'm not smart enough to figure that out, but at 50 cents on that dollar, I can figure out whether I'm safe. And so we're starting to see some first mortgage lending at those kind of LTVs on hospitality assets around the country, doing a hotel in Santa Barbara right now, looking at another hotel here in Chicago, and the development land deals, also looking at one in California, one in Arizona, and close one in Atlanta, right in the teeth of COVID. So that's kind of where
when we spoke last week, Alon, I think I wrote down land 3 times under your profile. It's like land. But when you just talked about some other assets, what would you say is a percentage land versus operating assets in your portfolio over the last 6 months?
So on the debt portfolio, the land is, I'm actually kind of looking to try to give you an answer. I have the hotel that we're closing. I have 2 loans, which look like they total up at about $15 million total, $20 million on 2 operating assets, which I would classify as kind of special situations, short-term lease rules that made them non-bank financeable, fights between partners. I have another $7 million fight between partner loans that I already got paid off on. Those were cash flowing assets. I'd say that's 33% of the book. Land is going to be closer to another, 55, 60% of the book. And then hospitality is sneaking in at 10, 15% of the book. On prep and mezz equity, the assets tend to be, particularly mezz, I think I'll speak to. It's down the field construction, right? It's like the construction's almost finished and they need a little bit more money. It probably would fit into Manish's definition of kind of prep could come in, but I prefer a secured position. And oftentimes, particularly when we're active here in our backyard, I have a good relationship with the first mortgage lenders. So I'm able to say, hey, let us in here as mezz. And those are almost all both. I have 2 or 3 of those. They're all multifamily projects. Understood.
So shifting over to you, Fish, you kind of you're in the same playground as Manish and Elon, but what's a little bit different? When you say what is your sweet spot? What are you guys making loans on out there? And what are your type of products?
Sure. So what we're not doing is hospitality right now. We're seeing enough opportunities in other asset classes, mostly in the residential world, multifamily, condo inventory, for sale, single family, that we're more comfortable in, and we can generate the returns that we're looking for. And we're not looking to take hospitality risk. We're also not looking to take most type of retail risk at the moment. But we have been doing mortgage mezzanine pref across the country. We've been closing deals, New York, Maryland, Florida, Michigan. So we've been pretty spread out. We have transactions going in California, in Nevada, and it's to cover overruns on deals. It's to help recapitalize deals as they've been completed. And it's people who just need money in 10 days, 2 weeks. That time is more important than anything else. And we're able to step up and get that done for them.
Understood. And Kathy, I'd like to shift to you because you're kind of you're a direct lender, but you also facilitate transactions at Progress Capital. when you hear kind of what we just heard from the last three panelists, is that what you're seeing when you're, and where do you operate? What are you seeing from your vantage point?
We close a large volume of transactions. Like last year, we closed almost $2 billion worth of transactions in as a commercial mortgage broker. This year, you know, the climate's changed and the lending sources are shifting. And for example, like CMBS loans this year,
Mhm.
year to date, are 50 billion, where last year they were 100 billion. And, you know, in the height of the market, they could be 230 billion for the same period. So the CMBS lenders, you know, are underwriting more conservatively. Banks are all displaced. Very few bankers are even at work. They're a little dysfunctional. They're being very careful about what they do. So we have spent a lot of time this year doing agency business, which is still
Mhm.
very active, and finding, you know, matching lenders up, borrowers up with lending sources like this panel that are not regulated as a bank or some other, you know, life companies are pulling back. Like everybody's just contracting. So there's still a need for money. So the money,
Right.
you know, the borrowers still need the same amount of money to do a project that they did a year ago. That money isn't always available today. So we've had to get creative this year as to how we piece that all together. And sometimes it's like a little bit of a pie. You know, you have a slice here and a slice here and a slice here, and next thing you know, it's done.
Right. And so when I hear the word creative, that's magic to my ears, especially for my clients, right? Because most of my clients nowadays already have mortgage financing. I've already got the institutional lender in place, Luis. I need to recapitalize. I need to inject some more capital here, or I need to carry my existing lender for another year or so. Kathy, what term sheets are you seeing across your desk that are being very active in that kind of marketplace, the secondary and tertiary marketplace? Which ones do you see are the most active, and what types of assets are they closing on?
Well, we see it all. I mean,
Mm-hmm.
honestly, I can't say that one is more active than the other, because
Mm-hmm.
where there seems to be the biggest gap is in construction. Because the senior construction lenders are lowering their loan to cost. So that's where most of the capital is needed. And also that's where you run into problems, because a lot of construction costs have gone up over the last year with all the tariffs. It's COVID and some other political situations have created an environment where capital is important and has become thin, you know, companies have become thinly capitalized. So whether you're buying a multifamily property and you know, you need to fill that gap, or you're doing a construction loan, I'm just saying that we're seeing it across all product types, across all categories.
And you're still seeing a lot of activity, right? You're seeing closings happen on a regular basis.
Yes, we're probably going to close at least $1.5 billion this year, even with COVID. And
Fantastic.
we are getting so many calls, because people they used to be able to pick up the phone and call their local lender. And, you know, like, oh, I used to borrow from Columbia Bank, you know, I got a call like that this morning. Well, they're not doing business anymore. I don't have any other lender. They've always had that relationship, and the relationship isn't there for them. So they're getting pushback, and they don't know where to go. We do so much volume that lenders are accepting the deals that we're bringing in, because we're already vetting them. So we already know they work. We already vetted the borrowers. We already put the deal together. We packaged it the way they want to see it. We've taken a lot of the heavy lifting from them so that they can move it through the system a little bit easier. And we're doing a lot of stuff with non-traditional bank sources.
So you're doing a little
Funds.
underwriting on the front end. Speaking of creative financing, that's the first thing I think of is Chris and C-PACE financing, which I didn't really know much about until we put this panel together. It was Ronnie Fieldstone from our firm that introduced me to Chris. If you guys didn't hear it at the beginning, C-PACE financing stands for Commercial Property Assessed Clean Energy. So it's just known as, I think there's also financing called PACE, but C-PACE is a different type of a financing product that sits differently in the capital stack. And the more I learn about it, the more it interests me, because it's something that appeals to a lot of people, that is available for development projects and existing operating assets. Chris, why don't you tell us a little bit about C-PACE financing, where it fits, how it's structured, and who are the appealing borrowers for that? I know you have an excellent illustration on your on your website of where it fits in the capital stack. It's kind of outside of the mortgage structure. It's outside of the kind of structures we've been talking about because it's tied to your taxes or in the municipality, kind of like bond financing, isn't it, Chris?
It is. Yeah. So thank you. Similar to what Kathy was saying, the market right now for your traditional or conservative lenders, they've pulled back, obviously. Everybody knows that. So there's a world that's been exposed, which frankly I'm a part of, which is, kind of an alchemy of municipal bond financing. You've got ground lease folks out there. You've got different other folks who are offering, all kinds of different financing solutions, which frankly, traditional developers never would have looked at even a couple of years ago. So PACE is interesting in that it's a non-ad valorem tax, which is a very fancy way of saying it's a tax lien. So is I borrow against, or I lend you money against your bricks and sticks. So PACE financing exists in about 37 states, of which maybe about half of them have functional, well-operating programs. And really what I'm doing is I'm doing a non-recourse, non-participating loan based on the stabilized market value of your property. So let's say you're here in Chicago, you're building a building for $8 million, it's worth $10 million. I can lend you about $2.5 million worth of net value. So it functions as kind of an addition to your normal, lender, whoever that might be. One of the nuances is that it fundamentally is a tax lien. So in the event of a default, I have to go through the lien process, which can take many, many years. So part of what we're seeing is there's interest now because especially in the hospitality space, when there's these, big mysteries, frankly, at, am I going to be able to get out? Who's going to do construction with me as a senior lender? And so we're filling in that gap. Also, as we've seen LP returns, or LP demands for returns get higher and higher as the environment's gotten tougher to lend in. And obviously people, there's higher risk. We are a much cheaper way of replacing LP capital. So we're more expensive than traditional conservative or, called traditional debt, but we are far less expensive than your LP capital. So we prime the senior lender, which frankly, biggest issue. They don't like that, but there are a number of features and, hopefully we can give them the reassurance, and the leverage levels that they feel comfortable making the loan.
And how do you do that? Because when I hear about that, the first thing I think about is my institutional lender calling me, with heartburn. How do you get the institutional lenders, the first mortgage lender, comfortable with where you sit and with your lien rights?
I think there's a structural piece of PACE legislation which exists all around the country in every state that it has, and that's really non-acceleration. So in the event, let's say you're going to build a brand new multifamily or a hotel asset, in the event there's a default, I can't advance my loan. So I can't demand principal and interest from you. I'm not going to give you a nasty legal letter, from the county saying, pay up. I have to sit in line and I have to go through the tax lien process. So it could be 3 or 4 years before I even get, a crack, so to speak, at ever taking back the property from your first mortgage lender. So if you can't cure a building's deficiencies in 3 years, there's a good chance there's something dramatically wrong and nobody's going to take it back. So the first thing is really one of structure. Secondly, we typically deal with new construction or really, really heavy value add rehab. So a lot of that really relies upon, giving you the appropriate capitalized interest, making sure that you even though we're somewhat sponsor agnostic because we're non-recourse, we're still deal. We're still going to underwrite everything that everybody else would. And, at the end of the day, we need lender consent from the senior lender. So I'm going to be looking to everybody else in the cap stack to literally, agree with my underwriting. So we're not going to over leverage your sponsor or your developer. So there's both structural and then there's kind of practice normal things. And typically we're giving people about 2 years worth of capitalized interest where they're not coming out of pocket. And so typically that's more than enough to get somebody to certificate of occupancy. And all of a sudden your construction lender's saying, okay, phew, I can actually lend on this project.
And so the title of our webinar today was basically, look, if you need money now, who do you call, right? So let's flip that on its head because you talked a little about construction there, Chris. What about existing assets? I've already built my multifamily apartment complex on Biscayne Boulevard. It's 25 stories. I need capital. I called Manish. I got Elon. I'm trying to get money from different places. How can you make a loan to that developer that's already got a built asset? Does it need to be LEED certified, or what are the kind of the pre-requirements and what are their options?
Every state, so PACE legislation in those 37 states varies slightly in each area. And then, it's really the counties or the local taxing authority, because fundamentally PACE gets passed right to your tax bill. So sometimes there's some nuance, but broadly speaking, what we're doing is we're actually working with a lot of groups of developers who need to, revolve their, whatever their high tilt mezz was, or, maybe there's a partner who you don't like. So as we're seeing it with a lot of hotel owners right now, we're offering rescue capital. And so if you've got a building that was constructed or had, PACE qualifying items, which are mainly sustainability related. So think your windows, think your roof, think your HVAC, think your lighting, which typically is about 40 or 50% of the cost of a building. We're going back and we're saying most states have the ability for me to retroactively go back there and finance them out. So as long as I can get lender consent, I can probably get you anywhere between 20 and 25% of the market value of your property. And that's typically enough to take out, that 8 or 10%, mezz slog out there. That's typically enough to, get some angry investor or syndicator.
And so when and I'm spending a lot of time with Chris, guys, and I apologize, but I did want to kind of flesh out the C-PACE financing all at once, is the idea that, whenever I hear municipalities and counties and states, it makes me nervous. I'm like, I don't have that lead time. But what I understand from you, Chris, is that most of the jurisdictions in which our firm has a footprint, Philadelphia, Chicago, Boston, Miami, that's already pre-approved, isn't it? It's already turnkey, ready to go. So what is that lead time from when I call you till I actually close on that C-PACE financing? What does that look like?
Yeah. I think, first of all, I would point out, although this is a public-private partnership, this is 100% private capital. So the normal you get involved with either TIF financing or other, new markets, or, whoever knows, the wide world of other alternative finance sources, that really doesn't apply here. So because it's not, government or taxpayer money, it's typically a lot easier for us to deploy. So right now, about 70% of the population centers in the US already have active participating programs. Some are better. So, there is some element of execution risk, but for the most part, it's pretty easy. It's all done by third parties. Typical execution takes anywhere between, right now, about 6 to 8 weeks with our firm. Certain areas like Florida, California, Texas are much quicker. And so, we've closed in as little, we did a large hospital, probably about a $60 million loan, and closed it in, under about 3 weeks. So we can move fast when we need to, and frankly, we rely on folks like like Kathy, and we rely on really sharp brokers, and then really good who have been pre-qualified. So when I look at somebody like the folks on our panel, we're really relying a lot on on speeding up the process by having good other capital providers in the cap stack. So the sponsor is like in every deal, they're the player that really matters.
So what is the typical rate of return or interest rate that you're charging on this type of financing?
Yeah, our typical interest rate is anywhere for, a large corporate user with quote unquote credit, we might be sub 5%. Most of our new development and construction deals are anywhere between, for really large ones, maybe 5.25%, all the way up to about 6.5% for the wildest one out in the middle of nowhere. I would say our strike zone for a lot of multifamily is probably 5.5 to 5.75. Typical amortization in term, they're coterminous with the economic life of the improvements, which is a little bit nuanced for probably what we're doing here, but typically it's about 25-year term and amortization. Prepay is generally yield maintenance during construction, and we step down after that. And interest rates, call it 5.5, 5.75.
Got it. So that's kind of where I want to shift our conversation now to the rest of the panelists. What is the cost of capital that you're putting out there? We heard about land loans from Elon. We heard about hospitality loans. Fish is kind of doing a little pref and mezz. Manish, what is your cost of capital? What's your LTV? Kind of what's your sweet spot, so we can let the world out there know?
I thought you were going to build to me. We were going from Chris to myself up.
No, you got to go after 5.75.
Yeah, Elon knows what I'm about to say. So, look, I'm going to preface this with, we're essentially that alternative to doing a capital call with your partners, right? And we really make sense when there's other value to extract. There might be the opportunity to buy your loan back at a discount, to buy your mezz out, or to capture value in some other way, right? So we're really coming in as equity, but
Mhm.
rather than debate the formal current valuation, we're pref equity, so we can sit on top of the reformed senior or mezz. So all of that being said, we're mid-teens, mid to high teens.
Right, that was a terrible terrible transition from Christy. I
But it's
apologize.
not current pay, and it's not personally guaranteed. And if you lose money, we'll lose money, right? We're coming
Right.
in as a capital partner.
So
Well,
I'm
you're
gonna-
also
Your
making-
job is to help us all not lose money and to hopefully double our money.
Well, you're also making loans on really high risk assets. I mean, we've gone around the panel here. The only person that said hospitality a few times was you, Manish. Elon, what do you want to say?
I want to jump in and save Manish here and mention, a product that where we're putting money out outside of my land loans, we'll talk about the cost of capital. I know you want to get there.
Yep.
But fundamentally, Manish is talking about pref equity and equity. We have
Right.
Actually north of there, so more risky than pref equity. We have a straight equity product where we will take the last dollar of equity risk in a disfavored asset class, right? Retail. Okay.
Mm-hmm.
So we have a product out there where we basically will take 100% loan to cost for a retail developer who's doing a single tenant net leased asset. Obviously, you got the strength of the lease there, but it's still retail. It's still 2020. It's still COVID. A lot of banks look at that and say, it's great that you got a signed lease. I'll give you, maybe in the old days, it would have been 90 or 85%, depending on the credit of the tenant. Now it's 75 or 80%. We will come in with the last dollar of equity there, and we'll do it in a way that the return on our capital, which if you turn that on its head and say, okay, that's the cost to my borrower, is higher than Manish is charging, right? These are fairly quick to turn deals. I'm making 25, 27, 30% of my capital. But what I'm doing for the developers is I'm saying, unlike a traditional real estate private equity shop, I'm going to recognize that you have a quick project where you've limited a number of the risks that are in this marketplace by having a signed lease, by having a GMP with your contractor, by having a track record, and by having a good tenant. And at the end of the day, I'm going to take 35% of the back end of your deal, 30% of the back end of your deal, something that is quite a bit less than a traditional last dollar real estate private equity provider would take. And that's quote unquote expensive capital. That's a good deal for the developers who are out there in the marketplace. And we're putting a lot of that to work.
I'll jump in and a lot of credit to
Go ahead,
Elon,
Manish.
because a lot of people won't touch retail. In our segment, we might take 5% up to 50 of the back end, right? Sometimes if it's 50, it's really because they're really desperate. It's almost a hope note in their case. They're saying, hey, give me something and don't have anyone sue me, right? So they're trying to get out of the asset. But sometimes it's as little as 5% that we're taking. And I think that's what Elon and I, at least Elon in that one product, is providing, the ability for the operator to control his destiny, to get the 2, 3, 4, 5 year, the upside 2 years out. It's really the way to look at it.
So when you look at we keep saying hospitality, how are you valuing the assets then, Manish? How are you appraising these assets now?
No, it's extremely, extremely difficult. So we've created a framework. We happen to own other hotels already. We've been invested in others. We're seeing a tiering of comeback and a tiering of what was slammed the worst, right? So we have a bit of perspective. Whatever was hurt the most is going to come back the slowest. But there are certain things that are very specific. If it's near an airport, if it's near a convention center, you have to make a binary judgment call. If it's a travel destination, on the shore, on the beach, honestly, they're probably not talking to us. Many of those are barely impaired or they're above. As a general rule of thumb, we're looking at 18, 19 cash flow and then making a decision as to, is it easy to see a reversion or is it challenging? When we look at those 18, 19 numbers, we find the most challenging where they have a very, very heavy element of intercorporate travel. For example, just yesterday, we're looking at a deal and it was in Texas. So Texas is generally pretty good, right, compared to other places. But that specific deal was near a convention. It was in a part of one of the major cities that was near a convention center and heavily driven by intercorporate. It's where a lot of people keep their back office, intercorporate travel. And that's really difficult to assess, right? And that's where I was talking to the operator, and is it 2022 that it comes back, or is it 2025? Right. And in this case, look, we're keeping the operator in. So that operator, in some senses, is ahead of me. We're going to allow that operator to collect their 3 to 4% management fee ahead of our money. So in many ways, especially when it's a very invested operator, they love this. We're not forcing them out. We're not kicking them out. They're actually still drawing a salary. They're still managing the place. But, you know, we're trying to be very deliberate, and it's difficult, but it's calibrating off of 18, 19 numbers. What we are not doing yet are deals that were not making sense in 18 and 19. We don't feel the need to. There's so much volume out there. So we're not looking, you know, if the deal didn't make sense in 18 or 19, why should I look at it now? So that's kind of our attitude.
So Elon, I want to shift to you because you're putting different products out there. You're making different types of them. What is your cost of capital on that? Because you do offer a couple of different types of products. So let me hear what
On that, thanks, Luis. On that first mortgage lending, thanks for letting me save myself from my expensive capital as well. You know, on that first mortgage product where you're really talking about lending, right? And now you're talking about, okay, what's our thesis is to be high enough in the capital stack that we're happy with the basis, period, end of story. We're not looking to take back any assets. And in fact, we're hopeful that that cushion that we leave by lending at, you know, post-COVID in the 50s, right? And pre-COVID, maybe in the 60s on land type assets is going to be more than sufficient to mean that we're always going to get paid back. Because who the hell's going to give the land, the asset to that guy at that basis, right? And we've done a lot of that. And on loans like that, we charge anywhere from 8% with maybe a point in and a point out to 10% with a point in and a point out. The 10% tends to be more of those special situation loans, short-term lease roll, fights between partners, something that, you know, to use Fish's term, needs to be closed in 2 weeks, right? Something like that will tend to be a little more in that 10 and 2 range, 8 and 2, and maybe even just under 8 and 2, call it L750 and 2, you know, something like that tends to be more traditional development land, good LTV, great locations, good municipalities, good zoning, shovel-ready type projects where we're really helping that developer close and bridge in 12, 18, 24 months. So that's kind of our cost of capital on those products.
And how much are you beating up the land valuation versus what the appraisal was pre-COVID versus what it is today?
So it's interesting, you know, land values really are residuals to the projects that are being built on them. And those projects tend to be a number of years out. I saw just as much bad land underwriting pre-COVID that I had to walk away from and say, hey, you want me to make a 50% LTV loan? And I'm happy to make a 50% LTV loan, but at what you're paying for the land, my 50% LTV loan is literally retail, right? And that, by the way, makes sense. These developers don't need to be idiots. They're smart people that are putting together big projects where at the end of the day, the land component is just not that big of a component of the cost of their $600 million tower. So at the end of the day, they can overpay for land. My problem is, as a lender that is secured by that land, I can't overpay for that land. So I don't want to say that so much that it's impaired the value. I think it's just forced me to march a little further up the capital stack and say, yeah, I get it. I see that the retail trading price for your land makes sense at however many dollars an acre, however many dollars a foot, but I'm only going to go to 50 cents on the dollar now post-COVID, where before, frankly, to be competitive, I was in the 60s.
Right. So I want to shift now to Fish because Fish is putting a little bit of both of those types of products out there, albeit not really touching hospitality that much. And when we spoke last week, Fish, you were telling me you had a deal flow, 450 deals in the last 30 days. What was that deal flow like, and that you're seeing, and what are you putting out there in the marketplace in your term sheets, whether it's pref or mezz?
Yeah, so our pricing ranges, the deal flow we're seeing is across the board. The quality is probably inferior to what it was on a pre-COVID basis, but the amount of the desire from developers to have capital is greater than it's been in a long time. The range of what we charge varies. Our mortgages on cash flowing assets that are leasing up is plus or minus 7%. Our land lending on mortgages is up to 50% of value at maybe a 1% origination fee and a 12% rate. Our mezz pref equity, depending on cash flow and lease up and what have you, 12 to 15%. The triple net retail development deal with a credit tenant will go up to 90-95% of cost at, call it 12%. It really just depends on each situation, the check size. We will do a $2 million check and we'll do a $50 million check. And the smaller it gets, the more expensive it is just to make up for the whole dollar profit. But we've got a really big range given how flexible we are and what we can do.
Mhm.
So let's focus in a little bit on that, Fish. What types of assets are you making loans on? Like last week, this week, what are you closing?
So as I said in the beginning, it's primarily multifamily. That could be ground up multifamily. That could be cost overruns on multifamily. It could be stabilized multifamily where somebody needs to pull cash out quickly. We did condo inventory about a month ago in Boca.
Right.
And those loans priced from 9% to 16%, depending on where in the capital stack they sat.
And what was the range of those loan amounts? I'm not sure if I heard that.
No, sorry, from $1.5 million on the low end to 19 million on the high end.
Got it. And you're, in my recollection, see, we've closed some deals together, you and I. You guys close very fast, 10 to 14 days. You guys are ready to go.
If the bar is organized and they have what they need for us, we can be there in 10 days, 2 weeks. Typically, what will end up happening is we will run a little bit faster than the borrower, and we'll essentially be there waiting for the borrower to deliver us information before we can finish off the legal component and close.
Can I interject here for 1 second?
Please, Kathy. Please.
Here's what I've been seeing, which is supported by what I'm hearing, is that there were many borrowers in the marketplace before COVID that would never, ever pay those type of interest rates. They would be like, what are you kidding me? I'm not going to pay up like that. Now it's like that does not scare them anymore. If they can get the right capital at the right, you know, cost to them and the right leverage, those prices don't scare anybody anymore where they used to. And it's not that they used to scare them. They were too snobby to say, I don't need that. You know, I can get my local bank to do it, or I can get somebody else to do it. But times have changed.
Yeah, I mean,
Kathy,
sorry,
go ahead, Fish.
Just as an
No, Fish,
example,
go
the last land loan we did pre-COVID, Q4 last year, was at about 7.25%. Land deals today for plus a point in, a half a point out. Land deals today for us are double digits. We're not interested. If somebody says it's a single digit rate, we just pass on the spot. So there's a really big gap from where we were 9 months ago.
Right. And one thing, a term that we heard from Chris earlier today was rescue capital. Kathy, what are you seeing from a rescue capital standpoint? Are you helping I'm going to talk about non-performing loans, kind of two-sided, right? Because now we're talking about distressed assets. Are you helping facilitate move non-performing loans to another lender, Kathy? Are you doing rescue capital for non-performing loans, or what are you seeing from that vantage point?
I'm seeing a little bit of it. I can't say I'm seeing a lot of it yet, because I've worked on probably a handful of them so far, and actually was able to help the client work it out with the special servicer. Because the stuff hasn't really made its way to the point yet where it's really become where it's bubbled up and said, okay, we have to do something, otherwise we're going to lose our property. You know, the foreclosures have been stalled. The banks don't quite want to do that yet. The special services are all overwhelmed and trying to figure it out. So time has allowed borrowers to take a step back and try to approach this from a more logical standpoint. So it's coming, and we all know it's coming. It just hasn't, that wave hasn't rolled in quite so fast yet.
Yeah, we actually, go ahead, Manish.
If it's relevant. So, you know, a lot of our projects right now are stalled because it's either waiting for the senior lender to get an appraisal or for the forbearance to wear out. People got nervous because November is when most people's first round of forbearance ended. And then still things remain stalled where the borrower may not be paying anything to the senior lender. The senior lender, often in the cases we're dealing with, are major institutions or CMBS, and they're not acting. And they're also incapable of acting sometimes. So the borrower might offer them something reasonable. Hey, I'll catch up on interest, but extend my maturity. Let me go interest only. And it's deer in the headlights, or servicers and appraisals and a whole bunch of drawn out process. One indicative thing I would end with is there's a major institution that put out a loan book of, I'm under NDAs, I'll be a little bit vague here, but approximately $1 billion. and they were selling a mixed bag of things where it was
Mhm.
across the nation, it was office, about 1/3 hospitality, multifamily. The interesting thing is their expectation was mid-90s is what they were hoping to get paid on their loan amount. And we'll see what happens. So that bid date was 2 days ago. We bid on a subset of it on the hospitality. But to Kathy's point, those people are clearly not doing anything aggressive. They're actually trying to see if they can get out stage left at 95 cents on the dollar. So we'll see what happens.
No, and we've had a lot of meetings within our internal groups at the law firm about, oh well, let's get ahead of the ball here, being ready for distressed asset transactions. And we kept putting all these, well, they'll be coming. There'll be so much activity, and we kept putting all these milestone dates out there. First, it was okay, July the 4th, then it was Labor Day, then now it's like, well, the election, and there's still not that activity out there. I think you guys are saying the same thing. We're not seeing a lot of demand letters or foreclosure complaints landing on our desks. The lenders are in such a waiting game at this point. It's surprising to us. At some point, the bill is going to become due. Elon or Manish, which one of you I think one of you mentioned you are active in non-performing loans or buying non-performing loans.
We are. But I'll go to that point. When we're looking at these NPLs, here we are 6 months after someone has stopped paying you, and they haven't hired Saul Ewing's litigation department, I'm talking from the lender's perspective, to go be aggressive. When I normally pick up these files 6 months after it, you would see all of that, demand letters, that's one of the things we request. Hey, show me all of your conversations and interactions and legal filings with the borrower. And their response to me is, we have none. So that's tougher for me, which means nothing started. You know, in the last crisis, even if they had not really made, especially if you're in certain states, it might take 3 to 4 years to take over the asset, but it often takes under 6 months to get a receiver in place. A receiver being someone that can protect the cash flows, particularly in hospitality, extremely important, right? So having a third party coming in to manage the asset, to make sure current cash flows are protected. This time, current cash flows are like 60%, 70% of what it used to be. But there's also no receivers in place, which is completely interesting and bizarre to me because lenders are just refusing to hire you guys. I don't know, Luis. Can I ask you a question?
Courts are closed. In many cases, courts have been closed. I mean, I know we see that here.
Right.
People would love to hire Luis and the firm, but to hire them and spend a bunch of money so they can tell you every month, court's still closed, court's still closed, court's still closed. They've been taking filings, but that's a perfect example. I don't know if you can get an order. I don't know the answer. Not a litigator, but I don't know if you can get an order appointing a receiver from a Chicago.
I'd love to ask Luis. Luis, what's going on? Is it not worth hiring a receiver? What's going on?
I think people are just in a holding pattern. This is unlike any other type of recession we've seen before, right? Because it's not really a true economic recession. It's really tied to this disease, this pandemic that everybody's been in pause for. We've been waiting for the vaccine. Now we got vaccine information. So it's one of a kind. I think everybody would rather avoid forcing their hand at this point because I'm not sure there's people to take over those assets. Like you've seen right now, they're still not reaching a breaking point of what the right valuation is to let go of the asset. Although we do have some deals that we know about certain clients that are in distress, primarily hospitality, right? Just what you identified, near convention centers, by airports. There's not going to be any conferences in the next 6 months. But at the same time, it's such a bizarre recession. We have multifamily performing fantastic. We have industrial doing well. Kathy, you've seen a lot of these types of assets. There's a lot of assets that are performing very, very well out there. What is the big part from my practice, especially as a developers counsels, where is the construction financing? There's so much money on the sidelines. You do need to start building. I mean, the only person here that does any kind of construction financing, I think, Kathy, was Chris, right? Chris, you do a little. You're part of that capital stack for construction financing. But Kathy, you're not seeing construction financing term sheets out there, are you?
Oh, I am.
Oh, you are.
Oh yeah, we've this year we've secured a lot of construction loans. You know, mostly in the New Jersey, New York metropolitan region, but construction.
What types of assets are they green lighting?
Well, the ones that I've worked on personally have been multifamily. I closed an $84 million construction loan for 630 units in Jersey City, and next week I'm closing a $26 million loan for multifamily building in Gloucester, New Jersey. So construction lending is still profitable for lenders.
Mhm.
because it gets them a better coupon. And if they're in the business and they know how to do it, sorry, and you can actually choose the right location with the right sponsor. I'm not saying that, a doctor who decides he wants to build a multifamily building is going to get a loan. But what I'm saying is the seasoned developers are still able to get construction financing.
Especially with delivery dates that are 2 years away. Like, well, we're going to be way past
Correct,
this
because they're
by
saying,
the time
okay, correct. And if the lenders aren't available, the funds are happy to put the money out.
I think Elon plugged some of that gap as well, right?
Yeah,
On the retail side, right? That's, you see that all the, like, I'm seeing, just like Kathy said, I'm seeing construction financing available, but maybe at slightly lower LTVs
right.
to developers that are doing retail. If they fit a box that is now a little narrower, that tenant's got to be the right tenant, location's got to be the right location, term has to fit. And I'm able to kind of top off that capital stack that they got used to filling with a much smaller slug, right? They got used to 90% loan to cost financing on a signed lease, and now it might be 80, it might be 75. But we're out there to fill some of that slug. And that has been fundamentally, and that's not construction debt, that's just construction money. That's development money. That is the last dollar of the cost of those projects that will provide at, I guess 3 times what fish charges. So
And Luis,
Call
and
me
this
on a
is-
I
landlord.
still have clients calling me. I have a couple of retail guys that, they only do retail, and they call me up and they said, I'm going to buy this half vacant retail building. And I'm like, got to get me the money. And I'm like, oh my God, like, are you crazy? But I'm finding it. You just have to be a little, you have to turn over a couple of rocks before you can put the
Kathy,
right
are you
lender
finding
together.
that because you get a lender or a capital provider like myself on the equity side who understand, like, that's pre-leased, right? Yes, it's half vacant, but this is the guy that does all the 7-Elevens. He's gonna put a 7-Eleven there or whatever. Is that kind of the nature of a lot of those deals? Or do you find that lenders out there are willing to go kind of spec on those things?
They're going spec for the right sponsors who
Got it.
have a proven track record of being able to turn around and know the retailers and be able to lease and have a solid financial statement that's backed by product like this that doesn't have a whole lot of holes in, that they don't have every one of their centers has, huge vacancy. So it's very selective, and there's no playbook for any of this because it's loan by loan, borrower by borrower, bank by bank, sponsor by sponsor, situation by situation.
Luis,
The
what
whole
we see
industry is.
for the
That's
past
not
couple
Hold on, let me go to
cycles-
Chris for a second. I've
sorry,
kept
Chris.
Chris in the dark for too long. Chris,
I
let
was-
me ask you something.
Not to
When
beat
we
up.
talk,
I'm sorry.
go ahead.
I was going to say
Go ahead,
that
you go.
on the sponsors, but every developer who sat there for the last 2 or 3 years and was waiting for that last 3 basis points or 5 basis points and all that, all of a sudden I've got folks who are still developing hotels. If you tell me that your certificate of occupancy is in 2 years, there's a good chance that there is a lender out there. Now you're signing full recourse now. There's a lot of different things, on the senior lending side, but the money's still out there. I think where there's this weird spot in the market, which isn't performing, which is effectively frozen, at least from my vision, is if you got a hotel or retail asset, in the next 6 to 12 months of delivery, you're in a tough spot. But I know folks, the folks, who are getting land acquisition loans by folks like, Elon and the group, those folks are sitting there and I think they're actually getting, pretty good bids. And these are not incredibly high, high leverage. So you're not getting an incredible return there, but interest rates are not insane. Most of the debt funds that we worked with, who like PACE, they've somewhat gone away, but there's a whole world of regional banks who has everybody cashed out, or everybody's made a little bit of money, in the stock market, who are typically sponsors, and not hurting. All of a sudden, these regional banks are flush with cash, and they're not doing crazy stuff, but they'll allow people in the cap stack. They'll allow a good sponsor to actually do a full spec build, and so we're still seeing it. Also, the insurance companies and Freddie and Fannie are powering the way. We've got a lot of exposure to Freddie pools. And there's been zero BPs, delinquencies or defaults. There's just still incredible strength. And, there's a lot of bad headlines, frankly, about, rental rates falling across every major market metro. But it hasn't really translated yet into, lenders, starting to skip town and saying, no, we're not going to give you a proposal.
But you also said, Chris, that you do rescue capital. Is that right?
That's correct.
How
Yep.
are you able to come in and do rescue capital when you need the lender's consent? They're still playing ball. They really just want more capital into the asset to kind of keep it afloat. They're playing ball. They're giving their consent.
Yes and no. It's all very sponsor driven. Somebody who's looking for, 80, 90% leverage, even to do a very good asset, we're never going to get lender consent. Some senior is going to kill me. They're not going to let us participate. So those deals are not happening. But where there's reasonable, amounts of debt, then typically the seniors are letting this happen. Frankly, it's all about that weighted cost of capital. We still make sense, when we're in there. Where our product doesn't function well, where frankly, Steve, Elon, and Manish's products really, is great, is we're going to hammer you on the prepay because we hold this on our balance sheet. Whereas they're super flexible. So it's just one of those things where, our product, we're going to limit you on proceeds. We're going to hammer you on prepay. The other folks on the panel here, they just have more flexibility. Not only can they deploy faster, but they can be more flexible with the exit too.
Excellent. That's what I wanted to hear. So as we near now the 1 hour mark, we might run over a few minutes, but I did want to go around the room one more time. Look, the people that are on this panel are people that we've closed deals with in the law firm. Most of the time, they're on the other side of the table, making loans to our clients, right? Giving capital. So we know that they do in fact close. Kathy's been a great referral source for the law firm. I've done deals with Fish. I know Manish is a client of the firm. Elon, we've done deals with you, and Christina, we've done deals on the other side of the table, helping our clients get their projects across the finish line. So what I wanted to do now, a lot of this was to highlight each of you, right? Because you're friends of the firm, either clients or people that have helped out our clients. Let's go around a little bit, and Manish and Elon and Steve Fish, and tell us, if our clients want to reach out to you, what's the best way to reach out to you? And what bar do you want to email you? Why don't we start with you, Manish?
Sure. So our perfect borrower is someone who's experienced, who's owned. I'm going to focus on hospitality here. If it's multifamily, send it to us, but it's unlikely it's going to be impaired enough. But let's say someone that owns 10 or 12 hotels, there's a subset of those that they want to keep. And they realize they'd like to either take advantage of the fact that their lender might be desperate at some point, or that they just need capital because they're next to an airport or they're next to a convention center. That is the perfect borrower, the fellow that has 10 or 12 assets. They want to preserve the value of 5, 6, 7 of them. That's going to take, call it 12 to 20 million of new capital across those assets. And we're willing to underwrite per asset. We're willing to have a relationship with a borrower so they can kind of fight to the other side. And that's the right fit for us.
Got it. And obviously people can communicate with you directly to your email address that was circulated to. So moving on to you, Elon, tell me what's your favorite bar that's calling you?
First of all, thank you very much, Luis. Appreciate it. Appreciate being a friend of the firm. Shout out to Barry Katz, who we've worked with here in Chicago, who introduced us. Much appreciated. In terms of clients of yours that should give us a call, really, I'm going to put it into 3 buckets. Your personal clients, Luis, who are developers who have some land that they've had under contract, and they have spent time to create value and perhaps, up the entitlements, and have gotten to a point because of where the marketplace is, that whole transaction isn't coming together when they have to close on that land. Give me a call. I will get them some debt to help close that land. They're going to have equity in that project anyway. They're going to have GP equity that they need no matter who their LP is going to be. Let them put that up in front of me, and I will get them to a good place. We'll act very quickly and with guaranteed execution to help them close on that land and bridge them for 12 months, 18 months, 24 months until the capital markets look different, because the land has value and they've created value. That's 1. 2 would be clients who are acquiring hospitality assets at new bases. The ones that are getting reset into that post-COVID basis that didn't even think they could get a loan, because who the hell's going to make a loan on hospitality? at the right basis, I can see my way clear to making that loan. And then the third bucket, just so I don't leave Manish out there with, as the expensive guy, folks who are developers who are doing retail development with leases in hand, and they don't need to all be AAA credit leases, and need a programmatic source of equity for their last dollar. It's usually going to be the folks who are just growing in to the ability to work with the Saul Ewing, right? Who are getting to that point where they've now had success and become a preferred developer for 3, 4, 5 of their tenants. And now they no longer need pass the hat capital for 3 projects at a time. They need programmatic capital for 30 projects at a time. Have them give us a call. We're good with that last dollar.
Perfect. Fish, let me go to you next, since you're in what deal guy that I've done deals with. Who's the right bar to contact you?
Sure. So the other thing I'd leave is mortgage brokers should contact us. If you've got clients that have pre-development deals, development deals that are over budget towards the end, deep renovation loans, reach out to us. Small balance, 1 or 2 million is okay. Larger, up to 40, 50 million is okay. We'll find a way to plug ourselves somewhere in the capital stack to help your client, to help the developer, and get their projects over the finish line.
Fantastic. I guess it goes without saying that we do fully expect any Saul Ewing attorney to be involved in these transactions, right?
Absolutely.
Kathy, tell us about because I know you do have a direct lending arm, and besides being a brokerage firm, I mean, who should be reaching out to you for assistance?
Well, first of all, I'm not confined by a box, which is a nice thing because we don't have one program. Anybody who has a need, has a commercial real estate property that makes sense, I'm happy to talk to them. I can figure out where to get them financing. We do have a direct lending platform that we've started a couple years ago, and we're like a 12 and 2, and most of the stuff that we're doing right now is for clients of ours who need to bridge a gap quickly, and we know what the exit strategy is. Because whenever you're doing any of these types of bridge loans, the exit strategy is the most important thing that you have to underwrite to anyway. So we're able to close quickly, 1 to 2 weeks. We don't make it very difficult, but there has to be a good story and a good sponsor.
Got it. And Chris, last but not least, why don't you tell us a little bit about, I mean, we kind of got a great advertisement already for who should be calling you, but maybe some final words before we end this panel.
Yeah. So either you or Ronnie Fieldstone are number one. Secondly, mortgage brokers are probably 3/4 of the business that we get. And then we go direct with sponsors. So there's myself, I sit in Chicago. We go nationwide. We've got 4 other folks on the ground in different states. So you probably have somebody close by to you who can field the phone call. As far as our perfect client goes, anybody who's swinging a hammer should at least consider us. There's always, getting lender consent is a total bear, but we hopefully will help you enough that you can get it. So anybody who's swinging a hammer with, a heavy rehab project or brand new construction, we'd love to participate. And where possible, we'd also love to bring in other capital providers because we always need to fill up the rest of the cap stack. So frankly, I get more referrals from the folks like in our panel. We consider them actually, friendly parts of the cap stack, and I can't do anything without them. So anybody here can field a call, and hopefully I can participate.
That's great. It's been an extremely cooperative panel. I thought it'd be more competitive when I put you all together, but I'd love to see that in the marketplace, and that's why we do what we do, right? We love to close transactions. I would be remiss without mentioning, Elon, you mentioned Barry Katz. Thank you for helping for the introduction. Mark Citron introduced us to Manish. Tara Carver from the firm introduced us to Kathy. I'll thank myself for introducing everybody to Fish and our client PMG, who's done some deals with Fish down here in South Florida. And Ronnie Fieldson, of course, introduced us to Chris Kane. Folks, thank you so much for giving us your time today. Everybody who's participated, thank you. Reach out to these folks directly. Reach out to me if you have any follow-up questions or someone on our team. Hope everybody has a nice, less soggy day than we're having in South Florida. Manish, Elon, Kathy, Stephen,
Thank you.
Chris. Thank you so much for your time, and I hope we'll be doing business together soon.
Thanks,
Thank you.
Louise.
Thank you.
Thank you, guys.